hang there, don't worry, because actually market corrections are way more common than expected, and we're gonna get into them.
Cool. Yeah, that's a great thumbnail. I can already see it.
What is a correction, Julia? And for all of us here watching, most consider a correction to have occurred when a major stock or index, such as we're going to use right now the S&P 500, declines by more than 10%, but less than 20% from its most recent peak. Today, the market was sorry, I said 8%. As of yesterday, 2 days ago, with a drop, we had a big one on Tuesday. It actually was at 10%. So we're right there in a correction territory. We're right now on a pullback, which we're going to see.
Oh, a pullback.
Yeah.
Cool.
And it's called a correction because historically the drop often corrects itself and returns prices to the longer-term trend. The longer-term trend we've seen since October of last year, the uptrend.
Interesting. Cool.
So then what should you know for these market corrections? Well, the first thing is that they will happen. No, markets can't go up always, neither can they go down always. They are unpredictable, so don't try to identify or time them, even though they have specific times, like tend to occur every specific period of time, which we're going to look into. Basically, because they tend to occur because of a different set of factors.
For sure.
Second, very important, which we're also talking about it, that you need to make sure that you are and your portfolio is well designed and with a very well risk averse portfolio, or maybe that you're willing to endure these drawdowns because they will happen.
For sure. And that's a really good point. And that's also kind of like sometimes a hard rule to maintain, but a really important one to maintain, which is that sometimes people can get caught in the trap of where they're kind of overexposed and they're really relying on their ability to time the market or time certain signals as a risk mitigation measure. And that's a really unreliable way to do it, regardless of what the basis is, whether that's economic data or just your gut or technicals, whatever. Anything that relies on timing is not good for portfolio growth. And generally, it's a pretty unreliable risk mitigation technique. So it's always good to set up a portfolio that can withstand those inevitable drawdowns before they actually happen. Because also, like, just kind of trying to dig yourself out of a hole, it's a lot of the time doesn't work, and it's also a really unpleasant place to be. So kind of preventing that from the get-go is really important.
Then, well, there are three maybe rule of thumbs for these market drawdowns. The first one is a pullback when the market dips from 5 to 10% from the recent market high. Right now, the market's on a pullback, being down 8%. Second, the most common one, a correction drop between 10 and 20% in the market. And the third one, a crash. The crash is when the market drops more than 20% from its highs, giving a aggressive decline, and normally sometimes typically proceeds into a recession.
So just for for context, so pullback, correction, and crash, of roughly what time scale are we talking for these? Because if it drops 5% over like 2 years, that's very different than it dropping 5% in like 2 days. So is there like a sense for time scale that people can use for this?
We're going to look into specifically the market corrections and the bear markets. Why not pullbacks? Because they tend to be more common. The market can drop 5%, but then right away recover the following days. But market corrections and bear markets are followed way more, and there's a lot of more information in this. So as we see, the definition on the market correction, 10 to 20% stock market drop. Frequency, once every 1.2 years for a correction.
That's actually a lot more often than I was expecting.
Every 1.2 years.
Interesting.
How long do they last? Very interesting, and this is what I really like. So they tend to last 4 months, the market correction, and the bear market, 16 months, 1.5 years.
Whew.
If we see, Julia, the highs of the market S&P 500 of this year, 2023, was on 27th of July. So it's been almost a little bit more than 2 months and a half. We may be getting into this correction.
Interesting.
We won't time it, but normally it takes 4 months, and it's been 2 months and a half.
And you know what's interesting about this is that it kind of gives, for me, it gives like 2020 a really interesting sense of scale, because in that, the market dropped like 30% in a month. And normally a market drop over 20% lasts about 16 months. So just like the velocity of that sell-off was really crazy. It was pretty unprecedented.
The average market loss for these market corrections tend to be 13.3%. This data since 1950, and the bear market tend to be 33% loss, with an average time to recover or 4 months. So it takes the same to recover for it to go down.
Mm-hmm.
That's why it's called a correction. They tend to recover.
Mm-hmm.
And the bear market, they tend to take longer, from 18 to 20 months. And the reasons, as we said it, they tend to occur with no specific reason, these market corrections.
Mm-hmm.
Overall sentiment, they can change depending on the year. And the bear market, well, mainly because of fundamental reasons.
It's also like with a crash, like real true crash, a lot of the time it's because of like larger structural problems that take much more time to actually address. Sometimes they don't even get addressed, but it is interesting to see that kind of like that kind of one-to-one relationship in a correction, whereas like a correction after like something pretty catastrophic, like a bear market or a crash, it takes a lot longer to recover from that.
Yeah, and actually here, so the correction start a bear market, for people who maybe be wondering now, and taking this into consideration, well, since 1974, only 5 market corrections have become bear markets. The last one being on 2020. So they're not very common.
I guess that's the loaded question. Do you, just in your speculative opinion, think that we are entering into a bear market because of this correction that we're in?
Possible, but I don't think we're gonna enter a bear market. So these are, as you can see, 2002 lasted 929 days.
Mm-hmm.
2008 517, and 2020, sorry, 33 days.
Yeah. That was that's some like 1987 shit, man. Like, that was really unusual. And I think like so actually like in this by these metrics, I guess that doesn't count 2022 as a bear market, right? Too, like for me felt very like bearish, I guess, for most of
it was a bear market. It was not a recession, but it was a bear market, definitely, because I think the S&P dropped 28%, almost 30% from the highs.
Mm-hmm.
So it definitely was both Nasdaq and S&P 500 entered into a bear market on 2020.
I always find this data pretty interesting, and it also kind of like shows how each, especially like big sell-off, regardless of if it's like 1987 or 2008 or 2020, they're all like so unique, but it is kind of like helpful to have a sense of scale, especially with these more predictable market corrections that happen more often, that are usually just not necessarily symptoms of something significantly larger, but just kind of more of a sign of like the regular turbulence that we might expect in the markets.
Yes.
So pretty interesting stuff.
Yeah, with bear markets with an average duration of 446 days.
Yeah.
Bull markets, almost 2,000 days. So definitely a big difference there. Markets tend to go higher.
Market line go up. That's how investors like it for sure.
Yeah. And this is, as I marked, the average drawdown on market crashes was 33.3%, as we already saw on the other slide. But these are the past market crashes since 1950. Obviously, I was born in 1998, so also 2008 crash, I wasn't even aware of it. Also 2009. On the 2020, I was aware, and that was like my first market crash that I felt on my portfolio. Apart from that, there's not too many of those that I can recall since I was even born.
For sure.
To know the average duration days, 342, and the average price decline.
Well, this is very much a testament as to why market timing is so unreliable, just because of how fundamentally different, especially crashes can be. And especially for like short options traders, like those can be the really catastrophic ones. Those can, if you're overexposed, those can wipe out like years of growth in like a couple of weeks sometimes. So that's part of why you need other risk management techniques in place before you even put a trade on. It's part of why that's so important for sure.
I wonder how people would have felt with this market crash, almost 50% on 2008.
You know what? I actually, so I did a back test on this. I don't know, a couple months ago, but at least in that data set, which I think went until the end of 2020, it was like, I think it was 2005 to the end of 2020. The largest loss that was ever recorded for a short SPY strangle happened in 2020.
Really?
It was like a $7,000 loss, $7,500 loss in that data set.
I would love to make those back testing. They look
They're fun, right? They're a good time.
yes. So that's it, Julia, for the market corrections.